Hi, welcome to the channel. My name is Langers and I am the Scruffy Trader, and I'm enjoying myself today because it's pancake day. Happy days, one of the best days of the year, where Winky makes Scruffy happy, because there's two ways she makes me happy. She makes me pancakes, and I'll let you figure out the other one. No, I better tell you, because you lot are degenerates. She makes the coffee, and we all know Scruffy likes a coffee, so I'm happy. So what am I doing? Well, I've been asked if I will simplify how top-down approach works when you're looking at a chart. So that's what I'm going to do. I'm just going to quickly show you how to top down a chart, just to fine-tune your entries a little bit better, and hopefully it'll make a little bit sense as we go on. It's quite a short video, just a couple of minutes, so please watch through it. By all means, ask any questions below. Help me to help you by subscribing to the channel. Let's see if we can make some sense of all of this. Let's jump on the charts and find out.
Right, okay then, boys and girls. True to form, I spilt my dinner down my front, so I've had to change my t-shirt. Scruffy Trader. But it's Star Wars, so I'm quite happy. Anyway, so what we're doing, as I said, I was asked if I would explain a little bit about top-down analysis. This is basically a follow-up from a technical analysis that I did yesterday about cable. I'll drop you the link in the description so you can have a look at the video and see how I actually broke down the chart, made my decision, and then look at today's date, which is the 25th of February, versus the analysis I did on the 24th, which I did at it was about 2 o'clock in the afternoon. It was between 2 and 3 in the afternoon when I got it done anyway. And then what happened today, and I was right. The market went pretty much to exactly where I said it was going to go, but it was based on a higher time frame and the information that I got from those higher time frames. So that's the importance of top-down analysis. Top-down analysis is okay. However, it's got to be relevant, because if you're looking at a monthly chart, it doesn't really tell you what's going to happen in the next 10 minutes. The way that I do it is it's almost like a rule of three time frames. So the first thing, if for argument's sake I'm dealing on a 5-minute chart, so you've got your 5-minute there, what does it really tell me? Not a lot, because today is the 25th of Feb, and that only goes back to 7 o'clock this morning. So it's basically 1 day's worth of information. So if I'm day trading, I need more than 1 day, because it's not going to tell me the key turning point, which is why if you look at some of my other videos, you'll see that I work on key levels, and I need to know where those key levels are. But the key levels come from a higher time frame, and that's where the top down comes. However, when I'm looking to get into a trade, I take the direction from 3 time frames back or thereabouts. It's actually depending on which methodology you're using. It's 3 to 6 time frames. The longer the time frame, the less you need to be. But I'll explain that as we go. So say I'm dealing on a 5-minute. What I realistically want to be looking at is a 30-minute. You know, how did I get to there, Scruff? How did I go from 5 to 30? Well, 5 times 6 is 30-minute chart. Okay? And the rule of 3, which is what you'll see in a second. So if I was to do this, and this is all I had nothing else to work with, I would take my zones off the 30, do this so you can see what I'm doing, so you can understand why. And zone and S&R line, support and resistance, and zones are always something that jumps out at the eye. Okay? Sore thumb, if you like. So there, it's a big turning point. There, turning point. Here you can see it's plateau, turning point. All right, and I'm just doing this quickly because normally I would do it through that, and I use a line chart just because it defines the turning much quicker But the process of the video is to show you why you do it, not actually how you do it, okay? So I'll just leave it on candlesticks so I'm not bouncing around all the time. So you can see the turning point, which is there. And there, all right? And you only want them around where the price actually is. Because when you're day trading, you're trading in the here and now, the hard right edge, which is these candles here. Doesn't make any difference what these did because it's going to take an eternity to get down there, okay? So that's why we do it. So that's how I would quickly mark up a chart that I'm going to trade with if I only had a couple of minutes to look at it. So it's there. So that's 6 back, all right? That was my markup chart. This is where the power of 3 comes in. 3 5's 15. This is the chart I'm looking at for direction. So in that, I can see that it's going up very nicely. So what would the play be? Well, I would then drop it back down into the 5. Just quickly looking at it, I've used one time frame to mark up my key areas. I've used the next time frame to get a direction. And now I'm using a time frame to get in, power of 3. And that's where these sort of things come from. And as you can see, when you've gone onto your 5 minutes, before you couldn't really see anything because it was just one day and it didn't mean anything at all. Whereas if you have it on your 30-minute chart, that's going back best part of a week, which for day trading is the here and now, which is what you want to look at. So drop that onto 5 minute. We can see how it'll play. And the way that you would work it is, you know you're going up. These are your entry points. So you wait for the train to come into the station and then you get on and let it go. And throughout today, that's exactly what it would have done. So the whole day would have been up because that's what the other chart told me to do. Okay, so if you started at 7 o'clock in the morning, well, let's just say 8 o'clock, London open, eh? So there's your open and you're waiting for your first trade. You would get it here. So at 8:30, the market's come back into your train station. There's where you're getting on because it's a break above there. And you would ride it into this zone or this S&M. So that would get you your first trade. If you scale out, that would be your first scale point. Or if you do it the way I do it, I open up multiple trades. The first one would have closed out there and it would have been pulled up into a break-even situation at that point because that's the way I do it. As soon as the first scale point comes out, goes to break even, I can forget about it the rest of the day. I've already been paid and it could potentially be extra money in the bank. So that went up, it came down, doesn't go anywhere near my break even point. So it would go up, the next scale point would come out. Still not next to the break even, down it came all the way and then stopped you out. So you've had 2 bites of the cherry and it's 10 to 1. But you're back in the train station. So what you would do at that point is you would jump back to your 15-minute chart and you would see if your parameters have changed. Because you can't just do this off support resistance. You need maybe an indicator, a moving average or something like that. I'm not going to go into that because that's strategy specific to yourself as to why you would know your direction, right? But basically, it would come down there, you're back in the station, you're getting back on the train because your theory is up, goes back up, gives you your third payout. So you're happy again. So you've scaled out, you're back to break even, so you're not losing anything, comes back, goes up to your second break even point or your second closeout point for this particular trade, get paid again, right? But at this point, because that's gone out, move your stop loss up a little bit. So you're getting a little bit extra if it comes back. And then it's gone up, which is 4 o'clock, cashed it out again. Super duper. That's your day over. And that would have paid you all day. And you've got other people that'll go, that's not scalping, Scruff, because you've missed out on this. You've missed out on this. You've missed out on this. Have I? Have I really? Wasn't part of the plan. Might be part of your plan, but if you try and catch that, all of that, and that, I'll guarantee you'll lose. Because you'll be trying to get in again, but your train station is here at the start of the day, okay? And if it went up to there, you got paid, so there's one again, you know, because think about it, there it is there. There was your initial train station to go. I call them train stations because that's what you're trying to do. You're just trying to get on the money train. And you want to be going in the right direction. So there it is there, comes in. You put your order in just above it, because you always let the market go to you. Don't try and chase the market. You try and catch a moving train, rip your arm off. Try it. So you want it to be stopped and turning around and taking you with you gently. All right. So up you go. 1p, 2p. Okay. Comes down to the same train station. Thesis hasn't changed. Goes back up. 3p. 4p. 5p. Okay. So that's 5 trades, all winners, very little risk, just by quickly looking at a higher time frame. And that's why you do a top-down analysis. That's kind of a quick, watered-down version of why you look at higher time frames to trade a lower time frame. Because the amount of times I get asked, well, I look at a 5-minute chart and I got the direction wrong. And I always ask the same question. Where did you get your direction from? Well, the candles were going up and it crossed a 20-period moving average. Right, okay. Where was the moving average at? That was on the 5-minute chart. No, right, okay. It's too tight, and that's why you get it wrong. Ripsaws, too much. You need a clear, defined direction. That's what you want for each trade. For all that went up, came back to the train station, and one thing and another, as I said earlier on. I'll show you. So that was your first one, went up and came back. When you're on this point here, this is your next trade. You reanalyze the whole thing to make certain that you still think it's going up. And if it is, fine, you're back on. A good tip for you is, if you've reevaluated and you think it's going down after you've already been up, just switch it off. Because what it means is there's indecision in the market. I'm talking about one day here. And that indecision can change like that. Because the reason why it's going down could be a number of reasons. The first one is it's profit taking. So you've got the day traders in that have come in here. They've captured all of this to 10 o'clock, which is the first scalping session. It's normally between 7 and 10 a.m. because the banks come in, they put it in, the market spikes up, but it always comes back from that initial drive. It'll drive up. It'll come back as it's sort of resetting itself, because you've got the people getting in and out very quickly, and you've also got the people who've got it wrong getting stopped out and things like that, and reimagining what they're going to do. So you don't know now which way that market's going. So if you changed your mind a few hours later, just step out. Because as you see here, if you were looking at it here and you think, well, it's going down now, yeah, you're right, it was going up first. And it's come down, you get a few pips, you think, great, coming up there, it's going down. Well, it didn't, all right? Your first instinct was right. So as soon as you've been paid and the parameters change, stop. Do it again tomorrow. You've been paid for today, you don't need to lose the money. And that's what I keep trying to tell everybody in these. It's a job. And when you do something, you want to be paid. You don't want the money taken away from you. And that's another way of doing it. But that's why it's important to have swing trades as well. See, I day trade because I have time. And I love the screen. I genuinely love the screen. I love trading. But a lot of the capital that I have comes from longer term trading. But those trades take time to play out. So there we are. It's just a quick summary, recap from yesterday as to the importance of top down. If you can master that, you're another step closer to being profitable. There we go. Right, call it a night, and I'll speak to you all again soon. So remember, do what you love, and money will follow. See you in the next one, guys.